Hello, everyone. My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. As you know, this week we're discussing the Elliott wave pattern, referred to as an ending diagonal. And as you may know, it is one of two types of motive wave structures, the other one being the impulsive move. And then on the bottom here, these patterns, this is a zigzag, this is a flat, and this is a contracting triangle, and we will be discussing those in the weeks ahead. So one thing I would like to, again, kind of address today is whenever we're looking at line diagrams, they're pretty easy to discern. If you're looking at, again, line diagrams, like it's pretty evident that this is indeed a five-wave move. For example, this is indeed evident clearly an ending diagonal. But I remember my own self, my own personal, say, trials and tribulations with the wave principle when I first started learning about it. This would have been in, say, the mid-1990s, early 1990s. And I was really good at memorizing the rules and guidelines, and I was really good at, being able to identify these line diagrams. But then sometimes whenever I moved over to a price chart, an open, high, low, close price chart, I kind of, it seemed like I would hit brain fog. I just like, I don't see anything at all. So it takes a little bit of a time and practice to kind of make that successful transition from looking at, idealized line diagrams of Elliott wave patterns and then being able to see that on a price chart. Now, there are some, say, tips and tricks that I've learned to pick up along the ways that I sometimes employ. For example, one of the easiest things that I would probably recommend would be that if you're looking at a price chart and you're kind of having difficulty pulling the waves out of it, what you can sometimes do is just simply apply a moving average, just a simple 5-period moving average. And what that does is it actually pulls the structure. It lessens the noise and pulls out those underlying movements that, as Elliotticians, we identify as waves. Okay, so going back to this price chart here, essentially what I'm looking at is really the price action between 2020 and over into the high here in late 2021, early 2022. Okay, and you can, again, clearly just kind of follow along. So when I was going through these price charts, and one thing that also, too, is worthwhile mentioning, as I mentioned yesterday, the ending diagonal, it's a pattern that does not occur all that frequently, probably, maybe 20% of the time or less. It's very easy to come up and show you examples of impulsive structures, but I probably had to go through maybe 100 or so price charts to really come up with some good examples of what an idealized ending diagonal looks like. So I'm looking at this formation here in Crown and Castle, ticker symbol CCI, and notice we have the move to the upside, and then we have the move to the downside, then we have another move to the upside. Again, notice the overlap. Okay, that is a key characteristic of the ending diagonal, and you definitely want to see that. And then you have the push higher here. Clearly, this advance is contained within parallel lines. Well, actually, moreover, the converging lines, the 1-3, and the substructure of the moves does break down into three waves moves. It's not as, say, clearly evident as I would like. Nonetheless, it does meet all the, say, rules and guidelines of an ending diagonal. More importantly, once we saw that, again, we started to see the volatile movement to the downside, and then we actually got to below the pattern here. That would have been a successful break back in 2023. And as I mentioned the other day, one of just kind of a guideline more than anything else, whenever you finish, complete an ending diagonal, typically the resolution of the pattern tends to occur in 1/3 to 1/2 the time it actually takes the pattern to form. So in this instance here, we came close. Okay, this would have been the halfway mark time-wise of the pattern. Now this information here that I'm sharing with you also too is kind of useful if you're ever working with, say, options. where the vehicle you're actually trading is somewhat time sensitive. So ideally by, again, late, fourth quarter 2022, again, ideally if we had adhered to the guideline exactly, we would have been back under the origin of the pattern at 114.22. We came very close, okay? Certainly following as far as we did, we came very, very close. Nonetheless, it is still a very important, very useful guideline. Okay, so this is actually how I would say label the internal substructure. Let me move this to the side. There we go. This is how I would just simply, well, let's go back to that price chart, CCI. This is how I would label it. Again, going from the low that occurred in March, 1, 2, 3, 4, 5. 3 is shorter than 1. 5 is shorter than 3. It has the look, it has the substructure. It works out well to be, again, an ending diagonal. Okay, now next let's move on and take a look at another formation. Now this is not as quite as textbook as I would normally like. Nonetheless, it does fit the bill. The substructure certainly is much more evident than what we just looked at. And this would be, for example, here. We did push above the extreme that we saw here back in November of 2020. But again, notice the three-wave move up, down, three-wave move up, down, three-wave move up. And as you can see in this slide here, actually, no, the next slide, this is Excel Energy. Okay, again, you have that rising wedge shape. Okay, now this is again going back to a very important, say, talking point regarding the wave principle and old school technical analysis. Pretty much anything that you can say, for example, if you have converging trend lines here, okay, this is your rising wedge. Pretty much anything that happens within this formation, okay, constitutes a rising wedge, okay, utilizing old school just chart pattern terminology and analysis. So anything that transpires within converging trend lines that creates this rising wedge is indeed just that. It's a rising wedge. But just because it is a rising wedge or appears to be a rising wedge, that does not necessarily mean it is an Elliott wave ending diagonal. Because remember, again, going back to Ralph Nelson Elliott's original work, he codified each one of these patterns, meaning each pattern has its own rules and its own guidelines. Okay, so just because it may look like a rising wedge or just because it may look like an ending diagonal doesn't necessarily mean that it is indeed an ending diagonal according to the wave principle. Now again, in this pattern here, once you see the culmination of the pattern here, this would have been back in September of 2022, big sharp reversal in price. And that's kind of, again, exactly what we want to see whenever we do indeed finish this pattern. We want to see that swift, sharp resolution of the pattern. And let's see how this one worked as far as that little guideline there, that we tend to culminate the pattern in 1/2 to 1/3 the time it takes the pattern to form. And in this instance here, again, you can kind of see the value of it as a guideline. It's not precise, but it is, again, just a kind of a good rule of thumb. We came very, very close to retracing the entirety of the pattern. Okay, so let's move on. Let's take a look at another example of ending diagonal. Now remember, as I was discussing yesterday, ending diagonals, they're a terminating wave pattern, okay? They're very limited as to where they may actually occur. They can occur in the fifth wave move of an impulsive structure. They can occur as wave C of a zigzag or wave C of a flat correction. Okay, those are the three spots where we find them. Now in this instance here, which was kind of cool, this is Bloom Energy Corporation, ticker symbol BE. I think this is an extended correction or a complex correction, i.e. WXY, and it does appear that that final move to the downside, pretty much the price action we saw during the bulk of 2023. Again, notice the overlapping structure, notice the converging trend lines, and notice the three-wave moves within each of the moves to the downside here. And again, sharp resolution. And even if you looked at a smaller, say, movement here, perhaps this is like maybe a small one up followed by an expanded flat. And again, notice I haven't done the calculations yet, but you even have a smaller little, what appears to be a kind of a ending diagonal here as far as the price action here back in, say, third quarter of 2024. And again, notice the sharp resolution, the big pop to the upside. Okay, that's exactly how an ending diagonal terminates. But in this instance here, I was just showing you again the versatility volatility of the pattern because, again, it can occur in wave 5 of an impulse wave, wave C of a zigzag, wave C of a flat. In this instance here, again, notice it is in this wave C position of a larger WXY. So ABC for W, X, ABC, ending diagonal, Y, again, nice little low here in bloom. Okay, I do have another example here, and this is going to be an NV5 holdings, and that is weekly chart level. Okay, so again, notice the key characteristics. You basically have 1, 2, 3, 4, 5, or 1, 2, 3 stabs to a new high. Notice that the market just seems to be struggling to make new highs. And as I say before, technical analysis, chart reading, wave principle, candlesticks, indicators, and oscillators. Technical analysis is a language, and the better you understand the language of technical analysis, the better you'll be able to understand the narrative of the market. So, for example, here, just going back to your basic chart reading skills, is you put a high in place here back in, say, January of 2022 or December 2021. And then notice subsequent price action pretty much throughout the entirety of 2022. We continue to advance, but these advances are more and more laborious. We're not seeing really any kind of travel from that high that occurred about 35.50, a year later almost, we're just only a couple of bucks higher. Where if you look at the advance here from 6 and change, look what happened during this period of time, up to 35. That's a huge move, okay? But during this period of time, it just, the market really struggled to make new price highs. That tells you something. And then again, look what happened as we moved into that first quarter and into the second quarter of 2023. So here's how I would, work the substructure. 1, 2, 1, running flat 2, wave 3 of 3, pull back in 4, 5 of 3, pull back in 4, and then 1, 2, 3, 4, 5. Again, you see that pattern, you see that rising wedge shape. But remember, make sure whatever rising wedge shape that you see on your price charts, you just dig a little bit deeper. Again, don't fall down the rabbit hole. Again, I'm not a fan or totally object to the idea of analysis paralysis, but I do want to just do more than read the headline. Okay, I want to read a little bit into the story to make sure that is wave 3 shorter than wave 1? Is wave 5 shorter than wave 3? The moves that we see, waves 1, 2, 3, 4, 5, do they look like corrective structures, i.e. zigzags, or perhaps a double zigzag if need be? But you really want to see some type of corrective structure in those advances, because remember, the ending diagonal, the subdivision of an ending diagonal is 3, 3, 3, 3, 3. Again, ideally, each one of those moves mean a zigzag. And again, very rare instances, as I mentioned yesterday, will I accept a double zigzag? Prefer not to, but nonetheless, it can be kind of difficult to find those textbook quality patterns. But once you do, as I've shown you today, they do indeed give way to some really, really nice volatility in the market, which again, of course, for traders is pretty much our bread and butter, that volatility. Okay, everyone. Well, that's about it for me for today. I will be back tomorrow, of course, and we will continue our discussion of ending diagonals.